Okay, the Japanese will say, they have a wonderful expression, the power of the market is reflected in a single candlestick line or in a combination of candlestick lines. And we saw before how we could see, read the power of the market or the lack of power of the market by the single candlestick lines, right? The hammer with the long lower shadow, the doji, the market has reached a point of indecision, the shooting star, the market's rejecting higher levels. But we could also read the power of the market based on candlestick patterns. So a bullish engulfing pattern, the market is moving down, and then we have a white candle engulfing, hence the name, a black real body. What is this showing us about the psychology of the market? Right, the bears are in control. Ideally, we want to see the first real body small because we want to see the bearish momentum losing steam. And then a white candle wraps around the black real body. Okay, normally, in equities, I like to see volume confirming it. Okay, high volume on the white candle, light volume on the black candle. We don't have that advantage in the Forex market. So white candle wrapping around a black candle. Now, this is a non-Forex bullish engulfing pattern. White wrapping around the black. You could use this in a Forex. The only difference is, again, because of the 24-hour nature of the market, this is non-Forex, this is Forex. So the difference is, in non-Forex, normally I want to see the open below the black real body's close. Forex, not as strict because the opening and close are going to be the same. Even if the opening and close, that's fine. As long as that white real body is higher than the black real body, this is perfectly acceptable in Forex markets. Yes? Yes, and and we're going to talk about that intraday. This is true with intraday also. Exactly, because in any other market, right. The question is this going to be true with any intraday in any other market? And the answer is yes, because the opening on a 15-minute chart is almost going to be always the same as the close of the prior 15-minute period. Yeah, pretty much in any market. Yeah, and we're going to briefly mention that during the intraday section, but that's true. So here in that prior slide, you see how the opening and closing. I just made a copy of it. The opening and closing are the same. That's a perfectly acceptable bullish engulfing pattern. And if we needed more reinforcement, we had another one over here. By the way, even if it's a pip difference, I'm looking at this now, pip or two. Like this opening may have been a pip or two higher than the actual closing. That's fine. That's okay. Okay, what beside the bullish engulfing pattern here with the white wrapping around the black, what also formed? What was the hammer? The first part, right, exactly. Remember, the hammer could have a black or white real body. So the low of the bullish engulfing pattern, which happens also to be the low of the hammer, should be a support level. Question? Okay, the question is, would I enter the market here on the hammer? Or after the bullish engulfing has closed? Okay, so the question is, would I enter the market here or after the bullish engulfing pattern? And I would do both. Either one is fine. The reason for that, look at this risk reward. Fabulous risk reward. Gosh. I don't see any, I'd have to even go back further. I don't know if there was a rally here. I don't know if this is a pivot high. I mean, the market could have been going down. But let's say even if this was a target area, I would definitely maybe, because there's no obvious resistance here, maybe look at some Fibonacci retracements, take some profits, 50%, something like that. But even with this hammer, wonderful risk reward. Yeah, I would still view it as a bull. One of the things that I had to do with the software is define what's a trend, and it's proprietary. But this would be a downtrend to me. Okay. Yeah, that's one of the things I had to think about. How do we know what's an uptrend or downtrend or lateral? So we've come up with a couple of moving averages. We actually use like a moving average crossover, but this would have been in a downtrend. Yeah. Okay, this obviously is in a downtrend. And here's a bullish engulfing pattern. And even, again, although this is classic. What we normally want to see is a much taller white candle and a small real body. Because we want to see the bulls really gaining a foothold on the market. And if for some reason you didn't have a chance to buy in the bullish engulfing pattern, maybe you weren't watching the market, this is the pound. As long as it holds support based on the close. One technique you could do, and I do this with windows. One technique you could do, let's say you're flat. You're flat during the session. For some reason, you didn't look at the bullish engulfing pattern or you didn't buy on it. And you see the market breaks the support intra-session on that bullish engulfing pattern. As soon as it gets back above that broken support area, you can buy. Now what you could do is set an intraday stop. Because you're saying, okay, if the market is strong, I don't think it should get under here intraday again. And you can keep a stop intraday under those lows. But here's another bullish engulfing pattern. Getting back to the question, how do you trade with it? Once again, this looks like a fine risk-reward. Notice how I always say, one of the things I always talk about, risk-reward. If you don't have a good risk-reward, you just don't do the trade. We're going to have a whole section on that. You buy in the bullish engulfing pattern. The low of the bullish engulfing pattern based on the close is your stop-out level. And my target is up there. I just use pivot highs. Just to refresh your memory, a pivot high is a high that is higher than the two highs before and after it. And a pivot low is a low the low is lower than the two lows before and after it. So essentially it's the most recent high. Let me show you this red line here that just came up with the arrow here. Is this a bullish engulfing pattern? Okay. Did it work? No. As soon as the market closes under it, if you're long, you're wrong. This trade, actually, I was going to say maybe it didn't work out, but maybe it would have. I don't know what happened here, but this looks like a resistance area. So just based on this, I don't know. But based on this, if you're buying it here, my upside target might have been over here. So actually, before the market broke the support on the bullish engulfing pattern, that may have actually worked out. But I'd have to look back further to make sure this is a resistance area. But let's assume it's not. As soon as the market closed under the bullish engulfing pattern, if you're long, you should be out. Or if you're looking to sell, that's the time to sell short. Obviously, when you get the bullish engulfing pattern, the second one, if you're short, you should be out of your short positions. Okay, as the market conditions change, we need to adapt to the changing market environment. Bearish engulfing pattern. Pretty much everything I said with the bullish engulfing pattern, the flip side, the bearish engulfing pattern, the market is moving up, and then we have a black real body wrapping around, engulfing a white real body. Bears are wresting control of the market from the bulls. Non-Forex. Yes?
Please go back to your slide 43. Let's say you go long. Similar question. Let's say you go long at your bullish engulfing pattern.
If we go long at which bullish engulfing pattern? The first one or the second one?
The second one.
All right, so we're going long at the bullish engulfing pattern.
The target price is up over there, the previous high.
Mm-hmm.
And then you see that doji and that black candle.
Right.
Would you consider closing?
Yes, we're going to look at adapting to the market, shifting our stops as we get new market information, because as time progresses, the way the market looks here is different than the way the